Welcome to our weekly market review, and I'll primarily be looking at what's coming up this week because it's all about the rates. South Africa will be up first on Wednesday, and it's anticipated that rates will remain unchanged at this meeting, but we're expecting the accompanying statement to carry a hawkish tone. The country's fiscal environment is not making the committee's decision any easier. National Treasury as well as private sector players have been sounding the alarm over what seems to be an incoming fiscal crisis. The upcoming midterm budget will likely lay bare the country's empty coffers as years of maladministration, bad policy and corruption have all sapped the economy. Also happening Wednesday, and it's likely to be the big market mover of the week, the Fed is also expected to keep rates on hold. What we will be looking at is the messaging in the accompanying statement, because while the Fed has remained hawkish in its tone, this could change in reaction to a mixed bag of data recently. We saw, for example, inflation tick up slightly, while at the same time the evidence continues to pop up reflecting households and businesses coming under financial pressure, like the depletion of excess savings and a sharp spike in bankruptcies. So ETM's head of research and director, George Klenos, and myself, we take a look at the state of the US economy and we chat a bit about our research into the looming debt refinancing risk facing US homeowners and corporates alike. That podcast will be out on Wednesday. You can look for it on Spotify. It's called Reset the Frame. The Bank of England is expected to up rates by 25 basis points on Thursday, although the economy is facing strong headwinds. While households are battling a cost of living crisis, inflation has remained stubbornly high, fueled by, among others, some strong wage growth. And again, the forward-looking statement may carry some market-moving potential, and we're expecting the central bank to keep the door open for further hikes to come. Then lastly, on Friday, the Bank of Japan is expected to keep its monetary policy unchanged. The yen's recent weakness may see Governor Ueda provide some hawkish guidance to support the currency, even though there's no economic reason to do so. So the central bank could signal that the end of their ultra-loose monetary policy is nearer than the market thinks, but they will stop short of materially changing its policy as it still views the ongoing price pressures as transitory. Other local data out this week is South Africa's latest retail sales and inflation figures. We're expecting a slight uptick in CPI. Internationally, the UK and the EU will be releasing their inflation and PMIs this week. The data will give further insight into the state of the respective economies. As for the rand, it's holding its own against the US dollar for now, and it's about the best that one could ask for against the backdrop of a consistently appreciating greenback. But the hopes of a rand making a wholesale recovery by year end are fading, and possibly the only announcement which could provide some support will be a commitment by the state to implement significant structural reforms and the liberalisation of the economy. But whether this will materialise, we will likely only find out on 1 November at the MTBPS. That in the week that was and the one to come for the markets.